But abhi, you require to hear out. Okay. Now, if you invest in bonds, which are fixed income securities, okay, debt. Fine. So these are called, commonly in India they call NCDs, non-convertible debentures. Of course, there are convertible debentures also. There are non-convertible debentures. So whenever you read a advertisement say that we are coming with an NCD, company will announce it. Now, bonds are basically issued by government, by corporates, okay, by state governments. Whenever they are raising money, they want to raise it for as a loan. They collect money from all the people and pay them some interest. Isn't it? That's a common understanding. So bond typically will have a face value. So I'm just putting a word face value like this. Suppose typically it's around rupees 100. It can be 1,000, it can be anything, but let's say it's 100 rupees. It will have a maturity period. Suppose it is 10 years. It can be 1 year, it can be 2 years, it can be 3 years, it can be 10 years, it can be 20 years, it can be 30 years. Okay. Government can issue bonds up to 30 years. So the maturity period is say 10 years, for example. I'm taking an example. So it is 10 years. It will have a coupon rate. Suppose it is having 7.25% coupon rate, which means that you pay 7 rupees 25% every year. The money is paid yearly. Okay, fine. So it has a face value, it has a maturity period, it has a coupon rate. Fine. So that means what you will do, you will get 7.25, 7.25, you invest 100 rupees today, you are going to receive 7 rupees 25 paisa for 10 years, and the 10 years you are going to get 107.25 back. The money is that okay? Fine. Now, these bonds can be marketable. That means you can sell them. Suppose you have bought it today, you can even sell in the market after 6 months, 1 year, 2 years, 3 years, 4 years time. And you can make a capital appreciation like shares. Or you can make a capital loss like shares. They can go up and down. Now, for example, a 7.25% bond, if suppose this was issued last year, today the rate of interest in the market is 6%. The same issuer, like suppose this is a government, who will issue 1 year back it was 7.25. Government is issuing now fresh bonds at 6%. Now, this is a bond for 10 years. What will happen if you buy this bond from someone who has bought it? You will get 7.25, but if you buy it from the government, you will get 6%. So if you let me buy this bond, you go and check in the market, the price of the bond has gone. Because nobody will be willing to part with this bond because it is 7.25 and the new bonds are getting. So that means if the price will be say 105 rupees, for example. Let's take a theoretical value. Suppose that the bond is selling at 105. If the interest rate goes down, the bond value goes down. Or if the interest rate goes up, the bond value goes down. The same logic. If the interest rate is going up, that means you buy a fresh bond from the market, you will get better coupon rate. Why you buy a bond which was sold last year at a lower coupon rate, so it will be selling at a discount. So there is an inverse relationship between the price of the bond and the interest rate. Is that okay? If you think the interest rates are going to go up, like for example, if the interest rates are going to go down now, now the interest rates are expected to go down, and we've seen that also. I'll just show you the slide where we find the interest rates are going down. The bond prices will go up, isn't it? So if you can sense that happening, then buy bonds at that time. Abhi bond खरीदने का time आ गया. Okay. If the bond percentage, if you buy today and the interest rates go down, you will get a capital appreciation along with your coupon. Okay. If you sell them, but if you hold them till maturity, then you are not going to get that capital appreciation because you're going to get 100 rupees back from the issuer. You can always dispose of the bonds if the price has gone up after the interest rates have come down. Suppose, for example, the interest rate goes down by 1%. Okay, you bought a bond which was 7.25%, and after 1 year, suppose it has gone to 110. So we have got a return of 17.25% on your bond. On 100 rupees, you have got 17% return without putting your money into stock market. You're getting 17%, so it's quite good. If you get 17% return from the bond market itself, why you going to risk your money into the stock market? Isn't it? So if you expect the interest rates are going down, then you should be buying bonds. And this is the time when people say buy bonds. And we'll see that in our schemes also, that's happening. Right? And we go and we say it's exactly happening like that. So this is one learning. Any questions there? Okay. Now, I just going to tell you certain things that I'm going to show you on an Excel sheet. The coupons. Now we started with the the ratio. I'm going to explain that first. Okay. Now, when we talk about stocks, we talk about standard deviation and beta as a risk measure. If the standard deviation of beta is high, we say the stock is risky. If the standard deviation of beta is low, then we say the stock is less risky. Isn't it? When you're looking at a market portfolio, then you look at the beta as a portfolio. Beta is higher, then you say it is higher than the market, riskier than the market. If it is less than 1, it is less risky than the market. And standard deviation is again the risk of a particular stock. Higher the standard deviation, more riskier the stock. When you're looking at a standalone, a stock, then you look at the standard deviation in terms of riskiness of the stock. Okay. Then, when you're looking at bonds, you look at the duration. It measures the risk of the bond. Just like a beta or a standard deviation measures the risk of a stock. The duration measures the risk of a bond. Okay, fine. So let's understand first of all what is duration. Of course, I have a slide and I should be sharing it with you. You can read it home. But let's say two bonds. One is 100 rupees. The second is also 100 rupees face value. This is giving you a 20% coupon and this is giving you 15% coupon. Both are 10-year bonds. Now we have to find roughly what is the duration of the bond. Okay? Without looking at the time value, without complicating the time value, how much you are getting every year the first bond? 20 bucks. In how many years you recover the principal money which you are investing? 5. Okay. So that means the duration will be little less than 5. Because if you look at the time value, how many years it takes to recoup your entire money when you are invested in a bond? How many times will you just press on a Google and say modify duration or duration of a bond and you find it's called Macaulay duration. That's the word which is being used in this side and that's the normal word we use. It's called Macaulay duration or duration of bond. Now, this bond, how much time it will take to recover your principal? Tell me. Roughly? 6 years, some months. Okay. Fine. So the duration of bond, the first bond is 5 years, second bond is 6 years. Those both are having 10 years maturity period. It's not the maturity period which determines the bond duration, but normally after longer duration will have longer maturity period will have always have a longer duration. But that is the thing, okay. But you need to calculate the duration to find out which is more risky. In this case, out of these two, the first one is less and the second one is 6 years. So the second bond is having higher duration. The other duration is fine. So duration is calculated how much time it takes. Just read out the definition which you have seen in the Google. Just say modify duration. Press modify duration. And you will find in Wikipedia or somewhere definition will be given and just read out.
Macaulay duration. Macaulay duration is the weighted average term to maturity of the cash flows from a bond. The weight of each cash flow is determined by dividing the present value of
go to and read modify duration. Okay. Of course, this is what is only in sense, but it's just describing you the formula which you haven't gone in. So just in a very simple language, you find what is the modified duration. Modified duration meaning कहीं लिखा होगा कि how much time it takes to recover your amount. कहीं लिखा है आपको मिला? Okay, just hold on. You will find that this thing. Okay, but all this what you are saying is all right because they are going to understand that. Okay? Right? Just focus here. Okay. So the Macaulay duration is basically the high duration bonds are more riskier and low duration bonds are less riskier. So that's why you have the low duration bond. If a person wants to take less risk, then you should put the money in low duration. But he will get his return measured. Suppose if you think there's a 1% decrease in the interest rate, low duration will give you a low return, but a long duration will भाग के जाएगा. Okay? Like for example, a long duration, just a thumb rule, 1% drop in interest rate, the capital appreciation is going to be 10%. Whereas a low duration, 1% will give you a 2% appreciation with the same amount of interest rate falling. Okay? Let's understand that.
Okay. So first of all, let's look at the word called YTM. Very important. Yield to maturity. Okay. This is a very, very important, jargon which you should all know. Now, if suppose there is a bond, I'm going to share you the Excel sheet so you can do it yourself. So coupon, suppose the bond face value is 100, coupon rate is 8%. Okay. Now, suppose, you're invested, you're going to get 88 rupees. Suppose the bond 7 years are remaining. For example, it is a 10-year bond, 7 years are remaining. So in the 7th year, how much you're going to get? 108. Okay, fine. Suppose you have this bond which is selling currently in the market at 100 bucks. Okay, 100 rupees bond issued 3 years back, assuming that, and 7 years are still remaining, and the bond is 100 rupees at par. It is not gone up, not gone down. So what is your return? 8%. Because you're getting 88 rupees every year, flat. Fine. Now, suppose the rate of interest now is 7%. Now the rate of interest, which the new bonds are being issued by the same company or by the government or any corporate, they are issuing the bond, and the rate of interest now they are issuing at 7%. Now what will happen? The price of this bond will go up. Okay. Let's see how much it will go up to match the same rate of interest.
Now, if you go to the market, this bond is going to sell you at 105 rupees 40. Because if you invest today 105 rupees minus and apply the formula, I'll just show you that, you get 88 bucks and 108 at the end of the year. So, which means your YTM is going to come 7%, which is exactly the same as the market rate. So that means now you have indifference whether you buy from the market or you buy from a secondary market, you get the price, the same price. If it's the same, then you can buy it from anywhere. Okay.
Now, how to have calculated, and then we can even make some calculations here again. How I've done, I put my cursor here, okay, here rather, nahi, here. So I'll just show you here. I put plus sign here and put the formula IRR. Getting IRR formula, yeah. And then just select all these values. 8, 8, 8, 8, 108. Okay, fine. And put it like this. Sorry. IRD 7. Sorry. The formula is like this, okay. The formula is I have to select everything, okay. IRR. That means, you are spending today 105 and you are getting all this. Fine. If you just select this, you will get the IRR. 7%. Have you got it? That means I just want to know that if I buy this bond at 105 rupees today and keep getting 8 bucks and 108 at the end of the 7th year, what is the return I'm getting? I'm getting 7% by using the IRR formula. Okay. So the 7% is YTM, yield to maturity, which means that if I buy this bond at 105 rupees 40 paisa and hold it till maturity, okay, then what is the return I'm getting? I'm getting 7%, which means I'm not going to sell it. Otherwise, 7% I'm not going to get. I may get more or I may get less. It all depends on the market situation. Okay, fine. Now, suppose if I say this bond was selling at 104 bucks in the market. Fine. Suppose you went to the market
and saw the bond is selling at 104. You calculated the YTM. How much is coming? 7.25. Now you have choice either to buy from the market or buy from the primary market or secondary market. Which market are you going to choose? The primary market or the secondary market? If this bond is selling at 104 rupees, अगर ये bond 104 rupees का बिक रहा है, and if you buy directly from the issuer, he is going to give you 7% coupon rate. But here, your return is going to come at 7.25 if you hold this bond till maturity. So where it is cheaper, in the market or in the primary market or in the secondary market? Yes, sir. कहाँ cheaper है? कहाँ सस्ता है ये bond? Primary market है या secondary market? Primary में सस्ता क्यों है? वहाँ तो आप 7% में ले रहे हो. यहाँ तो आपको रिटर्न मिल रही है 7.25% में. सस्ता है तो 104 रुपए का बॉन्ड, but actually you're getting 7.25% return, isn't it? Got it? So when you're just looking for a bond and looking at the prices, you should see, you should calculate what is the YTM. Okay. ज़्यादा की YTM भी दिया होगा हमेशा, so you can make a sense that this bond is cheaper. So instead of buying from the market, you will buy from the secondary market. I'll take you to the window where you can buy the bonds anytime you want, and tell you what YTM you're getting. Okay, fine. Is that clear? Now, another very important. So please listen. Don't
Yes.
just look in here and there. This is very important. Who can? So, what is to 8% return coupon? Sorry. Fine. Now, the rate after 1 year, the rate of interest has gone to say 6%, for example, or say 7%. 7% again. So, what will happen to the price of the bond in the market? It will go up or go down? Go up. Okay. Suppose it goes to 105 rupees in the market. If you buy it from the 105 rupees, you're going to get 8% interest. But if you buy it from the market, you're going to get 7%. Fine. Now when this bond was issued in January, and after 6 months you went and looking the price of the bond. January, हो गया, February, March, April, May, June. Okay. So suppose you're in the month of July. You found that the price was 105. Okay. But actually, the price was not 105. The price was 109 and not 105. The dirty price. And take the bond, but after 1 year you're going to get 8 rupees from the issuer. So that means 4 rupees which you are paid to him, it will come to your account. So the exact price will be 105 rupees. Whatever yield of 7%, isn't it? So the dirty price. Now just go and look the definition of dirty price and read it loudly. Anyone first? Dirty price of a bond.
A dirty price is a bond pricing code which refers to the cost of a bond that includes accrued interest based on the bond rate.
Just copy it and put it on a WhatsApp. Okay? Have you got it now? A dirty price will always include the accrued interest at the time of selling of the bond. Okay? So if you want to calculate the pure price, then exclude the interest to calculate what is the actual appreciation which has happened here. It includes both the capital appreciation as well as the interest which you are going to get. The other person is going to get both at the same time. So these are 9% return. Okay, 4% because of the interest and 5% because of the capital appreciation. When the return is 9%, he is getting straight away. Now, when you buy at 109 rupees, rest will depend upon the market situation, how it is paid. Is that okay? Is that clear, dirty price? Any explanation required? What is dirty price? What is dirty price? Well, include the interest.
So now we come to the bond value. So we have understood what is this thing. Now, if suppose the bond value is given to you. For example, there is a bond which is was 100 rupees, okay, and the current market price you want to determine, or it is not given to you, so you want to find out, and the coupon rate is 12%, and the year remaining 7. So what you do is that you calculate you then use the formula NPV. So let's see what formula it has been used here. NPV, okay, net present value. So just go to the NPV, and what is the rate of interest in the market today? 8%. So I'm going to put 8%. Okay. And then you're going to take only up to this. Okay. And enter. Okay. So I made a mistake. So I'm just going to use it again. So what is the rate of interest? 8%. Okay. I think I put all thing in one column. 120. So here you want to arrive at what should be the market price actually in the market. Okay. The bond is giving you a 12% coupon, okay, which is 12%, and 7 years are remaining. It's 100 rupees face value, and the current market yield is about 8%. You want to know what should be the price of the bond. Then you use the NPV bond. I have to calculate the YTM and to calculate what should be the real price. So both are same basically. Now you can just you take all this and calculate the YTM, it will come to 8%. Okay. For example, so in this case, what I have to do is that I have to add a minus sign here. Okay. Okay. Fine. If I use a minus sign here, and then I want to calculate what is the IRR, I can choose all of this. Okay. And enter. So I'll get 8% as yield. Is that okay? Which is exactly the current market interest rate. Fine. So what I'm going to do, I'm going to straight away share this with you so that you can just understand. ये वाला है ना आपका? नो सॉरी, MBBS. दिस इज यू. अच्छा, आपको लिख रहे हैं अभी. ये क्या नाम है? What's his name? सही सही. आ जाओ. Just save these two files and just paste it. तो डेस्कटॉप पे पहले सेव करो. फाइल सेव डेस्कटॉप, सेव एज डेस्कटॉप. ऑफ.
It already exists.
Okay. Say yes. Then the second file, open the next one. File, ऊपर जाके file.
Yeah.
नहीं, ऊपर ही.
Okay.
बॉन्ड के साथ दूसरी फाइल थी ना जो. Just go to the file.
ये वाला ही ना sir? Historic returns.
नहीं.
Not this.
Go to the file. I have closed it actually.
Okay.
Go to the next. Bond
यहाँ पे. हाँ.
दूसरी कौन सी खोली थी हमने? एक ही खोली थी ना?
एक ही खोली.
ठीक है, sorry. Go to rate cut then. Search.
Okay.
Search.
Okay.
Search.
Wait 1 second.
इतने पीछे आ रहा है सर्च. रेट एनालिसिस, रेट सेंसिटिविटी.
यही ना? ये भी डेस्कटॉप पर ही है सर.
इसको भी शेयर करो.
ओके सर.
दोनों को शेयर करो.
So you can just download these files. So we are going to rate sensitivity analysis now. Then I'll take you to the market, bond market also. Okay. Okay, so this is very important. Please focus. This is the most important thing. Okay. Now, I have taken bonds 20 years, 10 years, 5 years, 3 years, 2 years, 1 year. Now, typically a 20-year bond will be a long duration. Right? 1 year bond will be low duration. Though, of course, we have to calculate the bond duration by using that formula, but we're just skipping that. So, this bond is, first bond is, please focus here, okay? Just open your files, this. इसको open कर लो आप, जिसके पास भी है. Now, suppose the coupon rate is 9%. Okay? So, if you hold the first bond for 20 years, you're going to get 9 rupees for 20 years, isn't it? And the second bond will give you 9 rupees for 10 years. And the 10th year, you're going to get 109. Similarly, for 5 years, you're going to get 109 rupees the 5th year. So, like this. Okay? Now, look at this bond, 20 years bond. What is the coupon rate here? Now, suppose the coupon rate comes to, at 20 years, at 7%, the bond will be selling at 121 bucks. Okay. Suppose if the rate goes to, sorry, I need to make a change here. I'm going to make it 6% first. Make it 6%. Fine. So what I do is, at 6%, suppose the rate was 7%, for example. The bond price went to 121 because it was having a coupon rate 9. So interest rate came down to 7%, or rather I will say, suppose it was say 9%, for example. Let's say it was 9%. Okay. Fine. Now it has come to 8%. Fine. So at 9%, what should be the NPV? NPV will be at 9% here. Okay. So it will be 100 bucks. Fine. At 9%, you are going, the face value will be, the market value will be 100. At 8%, it will, suppose the rate of interest went down to 8%. So how much? It will be appreciation in 20-year bond, 9 rupee 82 paisa. So that means 9%. So 1% drop in interest rate has actually pushed up the market value to at 9.82. Just make those corrections there. I'll just explain it again. Because last time I was explaining, I just put the other way around it, the interest rate goes down. Okay, so I just saved that version. Okay. Suppose just think, this bond is 20 year, 9% is the rate. So what will be the what will be the market value of the bond? 100 bucks, because it's giving the same as the coupon rate. The market value is not going to go. Suppose the interest rate drops to 8%. What will happen? The value of the bond will go up to 109 rupees in the market. So what is the difference you are getting? 9 rupees 82 paisa. And what is the percentage change? 9.82. So a 1% drop in interest rate gave you a 10%, almost like 10% appreciation. Okay. So here we can check that also. Okay. We can just, go to the formulas here and check it. So this is this minus this, and this percentage is basically nothing, which is division of this. Okay. Fine. Is it okay? Now do the same thing here. 9%. Sorry, 9%. First take 9%. Then take 8%. Okay. And make the changes here also. Make it to 9% first. And make it to 8%. So what is happening to the second bond? The second bond, same 9 to 8%, but the bond has appreciated by 6.7%, 6 rupees. So a 20-year bond goes up very fast and can go down very fast. Similarly, compared to the 10-year bond, look at the 5-year bond. Okay, put it 9% here, and here 8%. Okay, and make this as 9, and this is at 8, na? So make it 8. So how much? 3.99%. So make the changes in everywhere. Okay. So make it 9%, make it 8%. Make it 9%, sorry, make it 8%. It is 9, it's 8. Here it is 9 and make it 8. Okay. Just see. Have a look here. Have you made 9898? So you found that which bond is giving you highest appreciation? If there is a decline of 1% rate of interest, which bond gives you highest appreciation? 20 years. And which is giving the lowest? 2 years. So a low duration bond will give you a, even if the interest rate drop, it will not, it will give you a very less appreciation. Okay. Now, just make the reversal of it. Just make, it was 9%. Suppose it has gone to now 10%. Look at, if the rate of interest rises to 10%, what will happen? So only make a change here. Okay, make it 10%. Instead of this thing, make it 10%. So if the interest rate goes up, the bond value is going to fall. So which bond affects the most? Which is the most riskiest bond? The high duration. The lower duration is less risky. Why? So risky here doesn't mean that it both includes, risk on the upside, risk on the downside. So here, because we always, our mind is tuned towards when it goes down. So which is riskier, as you can see, a high duration bond is more riskier compared to a low duration. Is that okay? Is that clear? ये समझ में आ गया? Have you followed? Just you can do all those calculations if you want. You can just understand it, and then we can move to the next one. This I was trying about, I think 7 8 years back. I just wanted to understand the concept, so I made this, okay, to understand it because it is not here anyway. I hope you are thinking it. What you'll get is, I'll just show you. In some, somewhere what you'll get is like this. So this is, slide which I'm going to share, bond duration. Just look at this, okay? Okay, first just read this. Can you read? Fatapat.
There is a measurement of how long in years it takes for the price of a bond to be increased.
Okay, chalo. Anyway, so that means the duration means that how much time it takes. So we have already done. Just read this. As we have seen that. Yeah, conversely. Yeah, this is treasury, the word which is used more in US. Okay, though we have also the treasury, but they call it treasury even for longer duration bonds. Okay, fine. Look at this. Okay, 30-year bond, 10-year bond, and 2-year bond. The price chart and the yield chart here. So if the interest rate goes up, okay, the bond prices, if the interest rates goes down, the bond prices rise. Okay, as you're seeing, the bond prices rise. 30-year bond will rise the most, 10-year followed by in 2-year. And the reverse happens if the interest rate goes up, the bond prices are going to fall. Can you see that? I'm going to share this slide with you. Last one, okay, just read. This happened in 2008. Then the financial meltdown happened. Read this.
For example, Vanguard's extended duration treasury ETF holds nothing but treasury bonds, but with an average duration of 27 years, its when interest rate crashed in 2008, the fund put up a positive 55% return. Then in 2009, when rates picked back up, it had a negative annual return of almost 27%.
Okay. When the interest rate came down, the bond values gone up because it's a very 27 years duration. Okay. But when immediately after the financial meltdown was over and things started looking up, then it lost all its gains what it has made and lost about 37% at time negative return because the interest
Rates now started going up and the bond prices were falling. Is that okay? Now we come back to our table here. Okay, I have not shown you the G-Sex, okay, which I just wanted to show you. You can just go to a site, go to a government bond, okay, go to, G-Sec, yield. Go to this site, okay. I think so. I've actually put this thing, yeah. So this is we always look at the 10-year government bond, which is a benchmark bond.
Bonds are issued by the government. Okay, fine. Who issues the bond? RBI issues. Who tells the RBI to issue bond? Our government. Because government needs money. Now, what happens every time when the budget is passed? That time you have a fiscal deficit problem in everywhere, all parts of the world. Okay, so when the finance minister presents the budget, she says that this is our income and this is our expense, and this is the fiscal deficit. Okay, she announces the fiscal deficit, and then she announces a borrowing program for the next year because we are going to borrow money to cover the gap. Okay, if this is always measured in terms of percentage of GDP. What is the gap? What's the fiscal deficit? Suppose it is about 5% or 4%, which is the norm. It is coming down, then it's very good news for the stock market. Stock market starts rising because they think that fiscal deficit is under control. When, if you are going to borrow more and it is going to be 7% of our GDP, then the market tank immediately after the borrowing programs are announced. So then you find a lot of volatility in the market at the time when the borrowing programs is announced, when the finance minister tells you about the fiscal deficit of the next year. Okay, because if there is a higher fiscal deficit, if you borrow more, that means you are in a bad situation, isn't it? If you can't live with your own resources, and then if you borrow more, then it's going to push the interest rates up because the demand for loan is going to go up, okay, and interest rates will start rising, and the cost of capital is going to fall, okay. Businesses will not flourish. So that is a bad news for the market. So if the government borrowing program is very high, then it will lead to a higher interest rates in the market and will pull down the industrial activity in India. Okay, so that's the reason in a nutshell. So the current government borrowing program is close to about 10 lakh crores this year. 10 lakh crore. It comes to about 12,000 crores per week. Okay, at the current level, which is a very heavy borrowing, which the government does it every Wednesday in the market. It will come and raise money to the bond market. So now the bonds are issued every Wednesday of various duration, 3 years, 5 years, 2 years, 10 years, 20 years. To keep a track of that, a 10-year bond is always considered to be a very holy number. Okay, it tells you what is the long-term trend of the interest rates in India. Okay, and always the equity market analysts will rely on these 10-year paper because the equity investing is also a long-term investing, so something has to be compared with the risk-free rate. So this is the risk-free rate, R, which you have learned in your life. Okay. So currently, the risk-free rate is 7.286%. That is the YTM. The coupon rate was something different, but currently, if you invest in this bond, you're going to get 7.286% if you hold the bond till maturity. This bond was issued somewhere in January 22, 100 rupees with a coupon rate of say around, the coupon rate is given down below. So if you look at the trajectory, okay, there's a chart also of this. So it is going down over the time, okay. Look at, the bond, say in October, the bond rate was how much? 7.44%. And now the interest rates are coming down. It is to 7.265%. There's a graph which tells you it was around close to about 7.8%, 7.7%. Now it has come down to 7.26%. Interest rates are now
peaked, they're coming down. So it's a time to buy bonds, because if the government bond is going to come down, all the interest rates will fall basically. Okay. So now we just we leave it here. We just go to the here. इतनी knowledge काफी है. अब हमें नहीं. This was all the things you must have known. Normally I teach it in 1 and 2 classes, but I just covered, try to cover everything in an hour's time. Right? Now low duration bonds. Okay. Short duration. Go first to, for example, long duration bonds. Okay. Or rather go to low duration bonds. Let's start with low duration. इसको पकड़ो, low duration. And of course, there is one more thing which there is something called risk ratios also, which I forgot for the equity. So you can download the risk ratios also. That data also will tell you the standard deviation beta of all the fund. Okay, fine. So then you can say that this stock is giving good return, or this fund is giving good return, but it comes with a high beta or high standard deviation. Okay, so that is to strengthen your analysis. So now low duration bond. So you just download the data. Okay, on an Excel sheet. Do that, low duration. I hold about 1 crore money in low duration bonds, because that was, the flavor of the year when I invested. Okay. Now I'm gradually shifting to long duration bonds. So just, just take out the first sheet, delete, and then direct plan. These are all direct plans. Okay. Category is low duration, since the category is same, so I can just delete them safely. Okay. And you can give the name of the file as low duration here. Okay. Just to keep a tab, this is a low duration. Okay. So that you can remember them. And you can make everything in one single sheet. Okay. I have done like that. Fine. तो ये आ गया आपके पास. ठीक है. अब now you just, highlight this and put Control T up to the 5th year. Okay. Fine. And then I can just change this thing. Okay. I'm just, hiding this ranking also at the time. And make it up to 2 decimal places, because the bonds generally give you low interest rate. So if you have to really measure, which bond is giving how much. And now this is a very interesting reading here, okay, which I'm going to explain. Now the interest rates have been softening around last couple of months. Fine, and you will find the trend here. Now, first of all, you just, select it on the basis of which bond is giving you highest return. Okay. Go for 6 months again and go from the largest to this thing and put a 0 if you're finding some number.
Flexi cap.
No, that is basically an advertisement. So this is, which one? Flexi cap कहाँ है वो हटा दो, वो सिर्फ ऐड का था, वो नंबर उसमें आ जाता है. That is not the flexi cap is basically an equity fund. So there is an ad which is coming up. Okay, this is the ad. Okay, so DSP flexi cap direct fund is actually an equity fund. So just delete that. Okay, otherwise your analysis will be wrong. So there will always DSP flexi cap will come in all your downloads. Just exclude that, because that is just the advertisement which they have given. Okay. So now tell me, which is the fund which is giving you the maximum return in 6 months time frame? I say, which is the second? Kotak. Now, Kotak low duration is fund where I have invested heavily, about more than 1 crore rupees myself and my wife. Okay, but this was what we were told to be invested about 2 years back. But still now the fund is still relevant. Okay, look at the 1 month return. Okay, how much 1 month return it is giving? Like suppose I have including the 10 months down the line. So in 3 months, it's giving still about how much? 1.54. So if you just make it 4 times, it's about 6%. So trajectory is going up. If you take the 1 month figure, it gives you a 7% return annualized. 3 months, it gives you 6%. 1 year, it gives you just 4%. That means
A year back, the interest rates were rising, now they're falling. So all these bonds, currently they're giving a higher return compared to what they were giving in the past. Okay, is that clear? This return is this. If you look at the 1 month return, tells you the picture as of now. The interest rates have shown a decline. The 10-year G-Sec paper has declined from 7.5% to 7.26%. It has pushed up everything up because all the bonds have readjusted. Okay, their interest rates had down has actually pushed up the prices of these bonds. Okay.
So now let's go to Kotak loan. Now what you do is just put them like this yellow marker, like which you did earlier. First five bond or whatever. Huh.
So like in first one, it gives 0.65. So into 12 should give around 7.8. But whereas it actually only gives 2.65.
This is telling you 4.11 because the latest month is giving you around 0.65. If you look at this bond, okay. Now let's say 1 month. Let's just
Sort it on the basis of 1 month. Okay. So if I sort it on the basis of 1 month, okay. So and the first is Franklin Del low duration, which is giving a very high 1 point.
that's an outlier. Okay. So then we'll understand why this fund is giving more. But all other funds are in the range of 0.73 and below, isn't it? Fine. Whereas 1 year figure is all are down around 4%, isn't it? So about a year back, the interest rates were higher. And from where you want to come to know the interest rate? Look at the GSEC. GSEC was trading at around 7.5% or 7.6%. Today it is trading at a government paper 10-year bond is trading today at 7.2%. The interest rates have started coming down. Okay, that's why the RBI, who is going to announce a further credit policy, they are saying that they will hold on the interest rate. They are not going to raise their repo rates. Okay, right? See, one more thing very important. The RBI they come and announce their credit policy. In the last three credit policies, they have increased the repo rates by it's about I think 6.75 percentage is now the repo rate. It was around 4.5% about 6 months back. So till COVID time they were not increasing. So now they started increasing because the inflation has been going all around very high everywhere because after the Ukraine war, the US inflation has touched about 9%, 10%. So then the RBI thought that it was right time to actually start raising the interest. Now, what is the RBI's objective? There are two objectives: government objective, RBI objective. RBI is basically they want to tame the inflation. They want to keep the inflation under control and keep a watch on the growth. The RBI mandate is that they have to keep the inflation under control and keep a watch on the growth. Whereas the government wants the growth to go up and also keep the inflation down. Okay, fine. So RBI, when they announce their credit policy, their main aim is to bring down the inflation. That inflation should be under control, not bring down, but under control. So what they will do when they announce the policy, there are two types of policies they talk about: the dovish and hawkish. When they are hawkish, they their commentary is hawkish, then they are saying that we are going to raise the interest rates up. Okay. When they are saying that they are dovish, they are accommodative, then they know that they are going to bring down the inflation, the interest rate down. So you can just Google hawkish and dovish government policy, okay? The monetary policy of they announce the monetary policy. So there are two types of when the RBI announces their credit policy after every 3 months when they meet. So we read and they find out whether they're hawkish or dovish for the future. Now they sound to be a little dovish or accommodative, that they're not going to raise the interest rates, they're not going to raise the repo rate because the repo rates are not going to go up because we have touched the height of the interest rates. Okay. Earlier they were increasing the interest rates, higher to making the interest rates higher, so you're buying cars at a higher loan, higher EMIs, your houses the rate of interest was going up, your housing loans interest rates are going up, but it seems that we have passed through the worst and interest rates is there or they're going to fall. That's why the bond prices are going to go up. Okay. So where are we? So here we find the interest rates are going down. Okay, which is pulling down the interest rate of everything down. So it is actually that is getting reflected in the bond market and the fixed income securities. You find They are currently in the last month, they are actually showing it upward. From the 3 months onward, you find they started going up because 3 month was 1.53, isn't it? Which makes an annualized return of 6%. Here it was 10.73, which makes about 8% return for this case. Otherwise, they're all, around 0.68 again, 7.5% return you're going to get if you invest in. After 1 year, this will, if the same trend continues, you will find this figure going up to 7%. Now you got it? This is the cumulative figure of the last 12 months. So if this trend continues, it will go up to 7% for the whole year. Is that okay? Now, let's take this thing and analyze before we close. Take, for example, Kotak Low Duration Fund, which I have invested, okay? So we go to, 6 months time frame and sort it. Kotak Low Duration Fund. Okay, just look at one, okay, and see what it is. This will complete the whole thing. I'm taxing you a lot, but ये बड़ा अच्छा important चीज है. बाकी जाके घर में देखना पड़ेगा आपसे. देखो, इसका fund size कितना है? 7,000. It is low duration. And what is the NAV? 2,988.32. It has gone up by 0.07%. Chrysler rank is 3-star. Riskometer is moderate. It's not very risky, okay, because it's a low duration. And the expense ratio is only 0.42. The debt fund will always come out a lower, debt expense rate. The SEBI actually tells you how much the fund is going to charge. They have put a cap, okay. No fund can charge more than so and so percentage. 2% is the ceiling, 2.25% is the ceiling for all the equity, and for debt it may go to 0.75 or thereabout 0.5. So they are charging 0.5 would be, I think, the semi ceiling. So it's 0.42. Category average is 0.42. It's expensive compared to the category average. It's charging you. Riskometer is telling you low duration. The fund has 98% investment in debt, of which 21% in government G-Secs. So they have invested in G-Secs, this thing, okay, and some corporate bonds also. Then, okay, look at this. This scheme has given you 4% kind of a return compared to the 10-year average of minus return. Okay, so this is doing very good for 1 year. 6 months also it has given you 3% compared to a Chrysler index of 3 points. So it's underperformed the Chrysler index in 3 months. Okay, and 6 months, and it is doing very well in compared to the 3 months attack. Okay. The category average has given 1.9, so it is outperforming the category average. Okay, and then the major thing to look at is tax treatment. Okay, just read this. Okay, now I'll tell you. Just first read and I'm going to summarize.
Tax treatment. What after 3 years from purchase, now the capital gain tax will be calculated. First 10 years of profit after indexation benefits. Short-term capital gain tax will be applicable with your income and tax at your effective tax rate.
Okay, now I'll just tell you. Now, capital gains tax, listen to me very carefully. If you are invested in bonds or bonds mutual funds, and if you remain invested for 3 years or less, short-term capital gain, you are going to be taxed as per your slab rate. Okay, like the slab rates are up to 2.5 lakhs, 0. If you are earning anywhere between 2 lakh, 0 to 2 lakh 50,000, 0. 2 lakh 50,000 to 5 lakhs, it's 5%. Then 5 lakhs to 10 lakhs, it's about 20%. And then 10 lakhs and above, it is 30%. Suppose if you are earning 10 lakh rupees and more, then you will be paying 30% tax on your income. Suppose you're making an income of 10 lakhs or more, okay? And if you derive a profit of 1 lakh rupees from the bond, you bought a bond of 1 lakh, it will become now 2 lakhs after some time, okay? Maybe within 3 years. Suppose, assume this absurd figure. So you earn 1 lakh rupees. What is your tax bracket? 30%. You pay 30% tax on it. Because you have sold them within 3 years. Is that okay? Fine. Is that clear? अगर 3 साल से पहले बेच दो बॉन्ड को, तो आपको एज पर स्लैब रेट टैक्स लगेगा जो आपके स्लैब में है. अगर आप 30% के स्लैब में है तो आपको 30% टैक्स देना पड़ेगा. If you are in 20% tax bracket, that means between 5 lakhs to 10 lakhs, then 20%. Okay. So, I may be forgetting some income tax slabs, but that is the thing. Okay, fine. Is that okay? But if you invest and remain invested for more than 3 years, then it's called a capital gain tax. It's a long-term capital gain. Okay. Then you have choice. Either pay 10% capital gain tax or pay 20% after taking the indexation benefit. अगर आप इंडेक्सेशन का बेनिफिट लगा लो तो आपको 20% टैक्स देना पड़ेगा और अगर आप इंडेक्सेशन का बेनिफिट नहीं लेते हो तो आप 10% टैक्स देते। लेट्स टेक एन एग्जांपल, सपोज यू हैव बॉट अ बॉन्ड फॉर 1 lakh rupees or say 10 lakh rupees, it has become 12 lakh rupees. Okay, you have other income. How much is your income? 2 lakh. Fine. Now first choice is don't take the indexation benefit. 2 lakh के ऊपर 20,000 रुपए टैक्स पे करो। Okay, separate taxation, no slab rate. So 20% tax होता है। So 2 लाख में 20% tax कितना होगा? 40,000. Pay 40,000. Matters over. Second option, take the indexation benefit and take 10%. Suppose you find that during this the inflation has been around 10%. So your money has gone from 10 lakhs to 12 lakhs. So first 1 lakh will be exempt. Next 1 lakh में आपको 10% tax देना है, which is 10,000. 10,000. हाँ, मतलब वो मेरे एग्जांपल में आ रही है, बाकी रियल में क्या आ रही है। But always the second option is where you take the indexation benefit is always better. Always take the indexation. The first option is not good. The second option, 20% after indexation, always work good. Maybe in my example it has worked the other way around. Okay, fine. So if sold after 3 years from the purchase date, long-term capital tax will be applicable. अगर आप 3 साल के बेचते हो तो long-term capital gain. Current rate of tax is lower of 10% or 20% of profit adjusted after indexation benefit. Any cess or surcharge is not included, which is 4% always. If sold before 3 years, okay, from the purchase date, short-term capital tax gain will be applicable. Any profit will be clubbed with your income and taxed at your effective rate. Is it clear? Is it clear? Just really to become very clear. जो आपका effective rate है वही टैक्स लगेगा। अगर आप 30% के टैक्स ब्रैकेट में होते हो तो आपको 30% देना पड़ेगा। अगर आपका 20% टैक्स ब्रैकेट है तो आपको 20% देना पड़ेगा। अगर आप उसको within 3 years बेच देते हो तो आपको short term capital gain which is as per your slab. If you sell it after 3 years, then you have two choices: either to pay 10% tax or 20% tax, but 20% tax with indexation. Okay, fine. There the slab rates are not counted. You pay either 10% or 20% special rates given by under the income tax. Then your slab rate not touched. चाहे आप 1 करोड़ कमाते हैं, 50 लाख कमाते हैं, नथिंग कुछ नहीं कमाते। जब up to 2,20,000 तो आप वैसे ही exempt हो। Okay, now a case comes when you are earning below 2,20,000. तो आप 20% टैक्स निकालोगे, आपको देने की जरूरत नहीं है because you are already making no income. Right? Okay, that's the additional benefit you get. So this is the portfolio. This is the last thing, and then you can do your exercise.
I have a private one which is 20.
I'm just going to finish in say 2 minutes, okay? So this is basically they are holding debt. How much? 98%. And others in cash. You know, they have to hold something in cash. You know, all funds, whether it's equity fund or bond funds or any funds, they have to hold some percentage of cash because if people come and say, I want to sell my bond, from where they're going to bring cash? Either they will be selling their holdings. Okay, so they don't want to sell, so they keep something as cash. So if you give 100 rupees to a fund manager, your 99% money will be invested in the market, 1% will remain in cash. Okay, fine. So 99% will be at work, 1% will be sitting idle. Assume that they will be again invested in a bank or something, will give you 4 to 5%.
99 is calculated on 99%.
नहीं वैसे आपके उसमें भी आधा परसेंट कुछ रिटर्न तो मिल रही होगी। अगर आपको सेविंग में रखा है तो उसमें भी 4% मिल गया ना। सेविंग में नहीं हो उन्होंने लिक्विड फंड में डाल के रखा होगा, which they can take it off on a single day. If you sell as liquid fund, next day your money comes to you. So हाँ, अब ये देखो आप, there are certain things. Number of debt holdings is very important, so please don't go away. Number of debt holdings 65. So they are holding 65 securities in their portfolio. Various kinds of bonds. Okay, it's a low duration. Category average is around 52-87, so it is in the mean. Modified duration, which is the Bangladesh duration, which is 0.62, so it's a low duration, less than 1. Okay. Then yield to maturity, very important. The last one, yield to maturity is how much? 7.63. If you have bought this bond and if these guys are not going to sell your bonds, I mean the fund manager, then you're going to get 7.5% return anyway. अगर ये बॉन्ड आपने कुछ पर्सनली खरीदे होते इसको आप बेचते आफ्टर 0.26 years you will get 7.5% return, isn't it? So even if you are getting 4%, don't get carried away because you will be getting your bond interest rate will go up because as they approach maturity, they are going to give you 7.63%. But it will all depend upon the fund manager action. Suppose he doesn't sell it away. Why he will sell? He'll hold it to bond till maturity. If you are getting only 4%, why he's not cool? He's going to not sacrifice your return. So yield to maturity is 7. So that's most important. While you're buying a bond, must look at yield to maturity. Even moment it may be given low, that yield to maturity tells you how much it will give you if the fund manager hold those bonds which is holding for you in the portfolio till the time of maturity, you're going to get 7.5% return annually. That's why I have not sold quote unquote duration because 7.62% is a very good return on a debt fund. Okay. Fine. Have you understood? So what is the yield to maturity? Anyone out of you? Yield to maturity क्या होता है? What you can think about?
It's basically it tells you the duration in terms of example the percentage of
return you are going to get if you hold the bond till maturity. Simple as that.
How much you getting out?
Yeah. ठीक है. अब बाकी आप पढ़ो. अपनी वो करो जो क्लास करो and then just read through because there will be a quiz tomorrow on whatever we have done. So there are 10 questions which talks about everything. Modified duration, YTM, everything. If you want, I can postpone to the next week, but we are approaching very close to the close of this. But कल दोपहर के बाद तो कर सकते हैं. Simple questions, don't worry about it. MCQs. But again, because I have a habit of taking MCQs, I am taking on a Google form. Okay? During the class itself, otherwise, everybody gets 10 out of 10 because you can Google the answer. Okay, so I'll give you the time. In those 10 minutes, you have to complete the MCQ. 10 questions. Okay.
देखो अभी अभी आपकी ताजा ताजा नॉलेज हुई है तो आप ना उसको आंसर अभी भी कर सकते हो. एमसीक्यू एक सेकंड मैं देखता हूं ये वाला है. ओके आई जस्ट शो यू द फर्स्ट क्वेश्चन. ओके जस्ट लुक एट द फर्स्ट क्वेश्चन. अभी सोचो कि नहीं हो रहा आपका. अभी ये देखो आप. अब इस क्वेश्चन को देखो आप.
Just put your answers, okay? If you feel like हो गया मेरा तो मुझे आंसर शीट दे दो, नहीं तो अपने कर दो. I will give you notes. Right? It's choice up to you. Just pull up your piece of paper and write the answer. And if you think after checking that you have done it well, give me the answers. I will record it. Otherwise, for next batch, I will be giving. You will be taking the next. फिर आप तैयारी करके. अभी ये impromptu है जो हमने आज पढ़ा. उसी में ये सब कुछ है. ठीक है. जो पढ़ा है और जहां मैंने नहीं पढ़ा है, give you a hint. Fine. So, when interest rates change, which bond will have the least price volatility? We have read it today, okay? So you can answer it. I don't think there is any toughness. A, B, C, D, just put your answer, okay? Is done? Pehla ho gaya?
कोई बात नहीं. चॉइस है आपके पास. अगर नहीं देना चाहते आप कल दोबारा से नया बना के ले आऊंगा. ओके बिकॉज यू हैव जस्ट रेड इट. ओके सो इट विल गिव यू अ फीलिंग कि हमने जो आज पढ़ा है उसमें से ही आ गया. आप समझ में आपको नहीं आया तो कोई बात नहीं. पढ़ के आ गया. ये कर लिया. When the interest rate goes up, price of fixed interest bond go up, remain change, go down. When the interest rate go up, the price of the fixed interest bond go up, remain unchanged, go down. आज ही पढ़ा. इंटरेस्ट रेट जब बढ़ते हैं तो क्या होता है? प्राइस गो अप और गो डाउन. जस्ट थिंक थ्रू. दोनों इनवर्सली प्रोपोर्शनल है भाई. सिंपल एज दैट. Is that okay?
नॉर्मल, अच्छा, ये जो कर्व होता है, देखो एक यील्ड कर्व होता है, शायद मैंने पहले भी कुछ पढ़ाया था आपको फॉरेक्स में, है ना। जो एक बॉन्ड है, देखो बॉन्ड का 1 साल है, 2 साल है, 3 साल है, 10 साल का बॉन्ड है, 20 साल का बॉन्ड है, 30 साल का बॉन्ड है। अगर यहाँ ले लें, बॉन्ड का पीरियड लिख लें और यहाँ इंटरेस्ट लगाएं 5%, 6%, 7%, 8%, तो या तो ये यील्ड का ऐसे बनेगा या ऐसे बनेगा। यहां 8% है, यहां कितना है 5% है, या यहां 5% है, या 8% है। दिस इज कॉल्ड द यील्ड कर्व. ओके, द शॉर्टर टर्म ड्यूरेशन is higher here and the low duration is lower. Longer term duration is lower. Here, the shorter term duration interest rate is low. As you go up, it goes up. Right? So normally, कौन सा normal होगा? Can you think about? Can you think about it in your mind? You know, when you are, suppose, for example, I'll just give you a clue. When you go to, somebody is asking you money for 1 month. Okay, he'll say some interest rate. When he says, I want to borrow for 10 years. 10 years का ज्यादा होगा या I'm not asking the answer, okay? 1 month का. तो जो normal है वो normal है. Okay. A normal year will be sloping upwards. So this is a sloping upwards, and this is sloping downwards. So which one is normal? Just think about it. अगर आप 1 महीने के लिए पैसा मांग रहे हो तो उसका इंटरेस्ट क्या होगा? और वही आदमी आपको 10 साल के लिए मांग रहा है, तो क्या आप उसी इंटरेस्ट पे दोगे या ज्यादा पे दोगे, वो आपने सोचना। तो अगर वो है तो फिर ये वाला कर्व होगा कि ये कर्व होगा, आन से 8 जाएगा, या ये होगा, एक आदमी 1 महीने के लिए पैसा मांगेगा और 10-20 साल के लिए मांगेगा, ऐसा होगा। या तो ये होगा या अपवर्ड स्लोपिंग होगा। अपवर्ड स्लोपिंग होगा या डाउनवर्ड स्लोपिंग होगा, तो वही तो करना है। भाई ये I want to see it looking for dangerous. The curve will look like this, upward sloping, or it will look like the opposite. अभी मैं 1 महीने मांगा तो आप बोलोगे इतना इंटरेस्ट दूंगा, और यहाँ 10 साल में मांगो तो 2 इंटरेस्ट, which is valid, okay? Just think. If I come to you and say I need money for 1 year, and if similarly I ask the money for 10 years, where you will be asking higher interest rate, here or here? Here, no? So your curve would be like this, no? On a time scale. Yeah. Is that okay?
Yes, sir.
Okay. हाँ, ये उल्टा हो गया. If the short term interest remains higher than the long term interest, the yield curve will be inverted. False, true, or difficult to say? Same logic. So if this is the normal one, then this will become inverted, isn't it? Is that okay? Fifth, interest rates and bond prices move in the same direction, move in opposite direction, sometimes move in the same direction, have no relationship. Okay. Now this is very easy. Okay, this is all you will be able to answer. These mutual funds select stocks for investment from the largest 100 stocks listed in the Indian stock market. Mid cap, large cap, small cap, mid cap. Contra funds. Very easy. Okay. Seventh, these mutual funds maintain portfolio largely in stocks. However, you cannot sell these units for 3 years from purchase date. You can save taxes showing investments as deduction under section 80C. ALS is value funds, focus funds. अभी तो करा है.
Yes, sir.
Okay. Eighth, these mutual funds invest in stocks and follow a strategy of purchasing and selling in contrast to the prevailing sentiment. The underlying assumption is that the herd behavior among investors often makes the market very close to very cheap at time. Okay, just read it yourself because I'm now I can't read it. I lost my energy now. Okay, okay, 9. आपने कोटक लो ड्यूरेशन का देखा था ना, ड्यूरेशन कितना था, तो ये तो है 7 है, तो क्या है ये, जस्ट गिव ओके 9 हो गया. नो नो, अपने तक रोको बात को. डोंट मेक इट पब्लिक. आई कैन मेक इट पब्लिक, यू कांट. ओके डन. 10th लास्ट वन. No cutting on your piece of paper. If you're going to submit, you have to submit it to me without any cutting. Okay. I'll give you only 1 more minute, okay? Okay, done? क्या लास्ट का देखना था? I'm just moving it in a span of जैसे स्लो मोशन में चल रहा हूं. Use a separate piece of sheet if you're making some changes, okay? Fine. इतना लॉन्ग मिसाइल क्यों चला रहे हो आप? यू कैन सी हेयर अगल बगल में, इतना दूर तक क्यों? ओके डन. Those students who are confident, please give all your sheets to sign. आइए फटाफट 1 सेकेंड में आ जाइए. Those who students who are confident, those who are not confident, keep your sheets with you. हाँ, बस अब ये लास्ट हो गया था. So please दे दीजिए अभी. Please give your sheets. Last and final. हाँ, शीट है, कुछ नहीं होगा, दोबारा आपका एक और हो जाएगा, एक और मिलेगा. चलो सब दे दो, कोई बात नहीं. सो आई विल कंसीडर बेस्ट ऑफ, एक इसको इग्नोर कर दूंगा अगर आपको होगा तो. आई विल इग्नोर द लोएस्ट वन. ओके फाइन. So let's start with, okay, just give everyone, okay, and I'll ignore the least out of the score which you have got. Okay, fine. The first का आंसर है, जब प्लीज दे दो. Okay, I'm just going to tell the answers, okay, fast. The interstate change has the least. 3-year bond will have the 1-year bond will have the least. Okay, fine. So एक सेकेंड, आप एक बार चेक कर लो सारे 2-3 लोग यहाँ पर आ जाओ. Whosoever feel like, yeah, 2 people should be there. Okay, all check this. Okay, हाँ, नहीं वही कह रहा हूँ. चेक. फर्स्ट हो गया सबका, अलग अलग चाहिए, उसका नहीं देना, एक आदमी. ओके डन. ओके सेकंड, when the interest rates go up, go down. 1 year. 3, normal yield curve is sloping. A normal is sloping upward. Yes, true. थर्ड भी ट्रू है. और सेकंड वाला जो है, it will go, and the interest will go up, it will go down. Okay. फोर्थ, इफ द शॉर्ट टर्म इंटरेस्ट रिमेन हायर है तो फिर आपका जो है द कर्व विल बी इन्वर्टेड. यस, इट विल बी इन्वर्टेड. ट्रू. Fifth, interest rates and bond rates are move in opposite direction. B. Okay, fine. C. Sixth one, large cap. Seventh, ELSS. Eighth, contra. Ninth, long duration. The bond, long duration. These funds invest mostly in government bonds, gilt funds. Gilt funds. A. बस.
फनीएस्ट पार्ट, सबने लास्ट वाला गलत किया, मैंने फर्स्ट वाला गलत किया.
बताओ कौन सा वाला है? ए. प्लीज. ये हो गया? सेकंड हो गया? सेकंड हो गया? थर्ड, फोर्थ, फिफ्थ. फिफ्थ का बी है. सिक्स का लार्ज कैप बी. सेवेंथ का ए, ELSS. एट्थ का कॉन्ट्रा. नाइन्थ का लॉन्ग ड्यूरेशन. 10th का G6 गिल्ट फंड्स. ओके.